So imagine a parent company realizes its subsidiary is just completely failing, right? They officially write off this massive internal loan, and they take a brutal hit to their standalone profit. I mean, the money is effectively just gone.
Yeah, legally speaking, it's a massive loss.
Right. But then, like 365 days later, when that exact same parent company merges its books with the subsidiary for the consolidated annual report.
Right, the consolidation phase.
Exactly. That massive loss seemingly just vanishes into thin air. Group profits instantly spike. The bad debt is completely erased.
To an outside observer, it looks exactly like a financial magic trick designed to hide real-world losses.
It totally does. So today we are solving one of the most, counterintuitive illusions in corporate accounting. We're exploring that immense tension between legal reality and economic reality.
And breaking down exactly how auditors uncover the truth behind those numbers.
Yes. So welcome, everyone, to a new episode on the Gap Advisors Ind AS Clinic podcast. We are diving deep into a scenario that routinely trips up even the most seasoned finance teams.
It really does, because it's a scenario that perfectly illustrates why you just can't read accounting standards on the surface. You really have to understand the deeper architecture beneath it all.
Right, because the moment a finance professional stops at that surface level, like with this specific transaction we're talking about today, they risk fundamentally misrepresenting the economic health of the entire corporate group.
Absolutely. And to make sure we dissect this with total precision today, the source material for this deep dive is pulled directly from the issue repository on gapadvisors.com.
Oh, man. Yeah. For the professionals listening who haven't utilized that site yet, it is just an absolutely monumental resource.
It really is. The site currently hosts over 4,500 detailed issues and their corresponding expert responses regarding Ind AS and Indian GAAP.
The sheer volume of practical, real-world application data in that repository is, well, it's staggering.
And the accessibility is what makes it so critical for the profession, I think. Any person can register on the site for free.
Right, completely free.
Yeah, and once you're registered, you can submit your own complex issues on Ind AS and Indian GAAP and actually receive a highly detailed, standard-backed response delivered directly to the inbox of the email you registered with.
Which is, exactly the kind of ammunition you need in the trenches. Like if you are an auditor dealing with a client who is pushing back on some complex consolidation adjustment.
100%. You need that bulletproof documentation to justify how you address the application of Ind AS in your audit files. You don't have to operate a vacuum. You can just lean right on that repository.
Precisely. And the specific puzzle we are unpacking today was actually featured in the 218th edition of the Gap Advisors Task Weekly newsletter.
Right, authored by C.A. Manish C. Iyer.
Yes, the director of Gap Advisors. And that's published regularly on LinkedIn. I think with over 230 editions published to date, it's really become this central hub for navigating these exact types of advanced accounting paradoxes.
It has. Now, before we jump into the mechanics of this vanishing loss, we do have to set our foundational parameters and, share our mandatory disclaimer.
Oh, right, of course. Let's get the ground rules out of the way.
Yeah.
First, for the context of Indian accounting, our functional and presentation currency is the Indian rupee, or INR.
Right. And any currency other than the functional currency is considered a foreign currency.
Exactly. Additionally, our reporting period always begins on the 1st of April and ends on the 31st of March. So keep that timeline in mind as we walk through this reporting cycle.
Right. And regarding the disclaimer, please note that the views expressed in this deep dive and within the source material we are discussing today are the personal views of the author and are strictly not binding on the audience.
Yeah, we are examining the theoretical and practical applications of these standards here, but you really are requested to seek the help of a professional expert before taking any action.
Or refraining from any action.
Right, exactly. Based on the views discussed herein, professional judgment applied to your specific facts and circumstances is, always the ultimate requirement.
Always. So let's lay out the facts of our scenario today.
Okay, lay it on me.
We have a parent company, which we'll call Holdco. And Holdco has a subsidiary, which we'll call Subco. But crucially, Subco is not a wholly owned subsidiary.
Okay, so Holdco owns a controlling stake, giving it the power to direct Subco's relevant activities.
Yeah.
But there are other outside investors, right?
Right, the non-controlling interests. They own the remaining slice of the pie. And that detail is going to be incredibly important later when we start allocating the financial impact.
Yeah, setting up that structure is vital, Because we aren't just dealing with a parent and a shell company, we're dealing with a parent, a subsidiary, and a group of outside investors who are watching that subsidiary's performance very closely.
Exactly. Now, here's where the trouble actually starts. Subco is bleeding money.
Oh, boy.
Yeah.
Mm.
The business model isn't working, or maybe the market has shifted, whatever the operational reason is, Subco is racking up huge, sustained losses.
Okay, so Holdco, acting as a prudent legal entity,
Right.
looks at its separate, standalone financial statements. It looks at the massive advances like the loans it has given to Subco over the years just to keep it afloat, right?
Right. And it also looks at the initial equity investments it made.
Yeah.
And Holdco management, along with their auditors, come to this harsh, undeniable conclusion.
Which is that Subco cannot pay this money back.
Exactly. The funds are not recoverable.
Wow. Okay, so this is the moment the legal reality really asserts itself, isn't it?
It is. In Holdco standalone books, Holdco is a separate legal person from Subco. And as a separate legal person, it holds a financial asset, basically, a right to receive cash from Subco.
But because Subco's financial health is deteriorating so badly, the expected credit loss on that financial asset has just skyrocketed.
Exactly. Holdco has no choice under the standards but to recognize that reality.
So Holdco takes the hit. In its standalone books, it fully provides for the doubtful advances and impairs the total investments.
Right. It debits its profit and loss statement, recognizing a massive expense, and credits a provision account.
Effectively dragging the carrying value of that loan and investment down to zero. Holdco's standalone profit just plummets. They've accepted the pain.
They have. But let's look at the other side of the legal fence. What do you think is happening in Subco's standalone books?
Well, see, this is what always strikes me as the ultimate accounting disconnect. Like, Subco is simply going about its business, continuing to record its operational losses. But critically, Subco hasn't written back those advances.
Right. They haven't. To Subco, that debt to the parent company still exists on their balance sheet as a massive liability. And their share capital, representing Holdco's investment, continues to be reflected at its historical value.
Right. And why doesn't Subco just mirror the parent? Like, if the parent says, I'm never getting this money back, why doesn't the subsidiary just say, great, then I don't owe it anymore, and write down the liability?
I know it sounds logical, right? But it's because accounting for a financial liability is fundamentally different from accounting for a financial asset.
How so?
Well, Subco still has a contractual legal obligation to pay Holdco, unless Holdco legally forgives the debt.
Oh, like a formal waiver.
Exactly, a formal legal relinquishment of their right to collect. Unless that happens, Subco cannot unilaterally decide to de-recognize the liability just because they are broke.
Right. A borrower cannot simply erase a debt from their balance sheet because they lack the capacity to pay. That would be wild.
It would be chaos. So you end up with this profound asymmetry in the standalone ledgers. Holdco has recognized a massive loss and reduced the asset to zero, while Subco still shows the liability at full value.
Which brings us right to the core questions posed in the issue from the Gap Advisors repository.
Yes, the 31st of March rolls around. It is time to prepare the consolidated financial statements, the CFS.
We have to mash these two asymmetrical realities together. And the queries from the user are highly specific. Like, when preparing the CFS, how is this provision reflected? Is there a direct credit to retained earnings?
Right, and what happens to new advances provided during the year?
And fundamentally, what should be the treatment for the provision made in the books of Holdco, for which there is absolutely no corresponding carrying amount in the books of Subco? Like, where does the corresponding credit even go?
These queries get right to the heart of the confusion. I mean, the practitioner looking at this is staring at a one-sided provision. They know they have to eliminate intergroup transactions, but how do you eliminate something that only exists on one side of the equation?
It feels like trying to balance a scale with a phantom weight. Holdco has a provision, Subco has nothing to match it against.
That's a great way to put it.
Think of consolidation like a corporate MRI. The standalone books are like x-rays. Holdco's x-ray shows the legal contracts, the loans, and the provision for the bad debt. Subco's x-ray shows the corresponding legal liability.
Right, they are looking at the legal bones of the organizations.
Exactly. But the consolidation MRI is designed to strip away the legal skin and bones, to show the blood flow, the actual economic reality of the unified group.
I love that analogy.
The problem is, when we run this MRI, the legal structures tell us a massive loss occurred, but the economic reality might tell a completely different story. So how do we reconcile the X-ray with the MRI?
That corporate MRI analogy is brilliant because it perfectly sets up the golden rule of consolidation under Indian accounting standards, specifically Ind AS 110.
Okay, Ind AS 110 laid out for us.
The fundamental principle of Ind AS 110 is that the consolidated financial statements must present the financial information of the group as if it were a single economic entity.
A single entity.
Right. A single entity cannot owe money to itself. It cannot invest in itself. And critically, it cannot recognize a bad debt from itself.
Wow. Okay, so we have to enforce the principle of elimination. Let's walk through paragraph B86 of Ind AS 110, because that acts as kind of the operating manual for this corporate MRI.
Yeah. Paragraph B86 is meticulous. It outlines the foundational steps we must take. Step 1, which is found in Clause A, dictates that we must, quote, combine like items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of its subsidiaries.
Okay, so that is the brute force step. You literally just stack the two ledgers on top of each other. Subco's cash plus holdco's cash, subco's trade payables plus holdco's trade payables. You just combine the raw data.
Correct. But obviously, brute force addition creates immense distortion.
Because it double counts the economic activity.
Exactly. It double counts everything and leaves all those internal, artificial family transactions completely intact. Which brings us to the surgical part of the MRI Clause B.
What does Clause B say?
This clause requires us to, quote, offset or eliminate the carrying amount of the parent's investment in each subsidiary and the parent's portion of equity of each subsidiary.
Okay, let's break down the logic of that. Why do the investment and the equity obliterate each other in the consolidated view?
Because we are shifting from the legal perspective to the economic perspective. From Holdco's legal perspective, buying shares in Subco is an investment asset.
Right.
But from the single economic entity's perspective, that transaction was really just the group moving capital from its left pocket, the parent's bank account, into its right pocket, the subsidiary's bank account.
So the group's overall net worth didn't actually increase. The cash just changed locations within the same pair of pants.
Exactly. Therefore, Holdco's asset, the investment in Subco, must be canceled out against Subco's equity, which represents Holdco's ownership claim. They neutralize each other to prevent artificially inflating the group's balance sheet.
Okay, that makes perfect sense. We are stripping away the internal architecture to reveal what the group actually owns in relation to the outside world. But what about the loans? What about that massive provision Holdco made?
That brings us to Clause C. And Clause C is the absolute crux of this entire deep dive.
Lay it on me.
It states that we must, quote, eliminate in full intergroup assets and liabilities, equity, income, expenses, and cash flows relating to transactions between entities of the group. I want to draw everyone's attention to 3 vital words in that clause.
Eliminate in full.
Eliminate in full, yes.
Not eliminate the matching amounts,
Yeah.
Not eliminate the net difference.
Exactly. It mandates the total eradication of the intergroup relationship from the consolidated financials.
So if we apply this rule directly to the GAAP advisor's query, in the consolidated financial statements of the Holdco group, the investment in the subsidiary must be eliminated.
Right.
The advances given to the subsidiary must be eliminated.
Right.
And crucially, the provisions made on those investments and advances by Holdco in its separate financial statements.
Right.
All of it must be fully eliminated.
Every last bit of it. That is the direct, standard-backed answer. The legal fiction of the internal loan is wiped away, and the provision attached to it just goes right with it.
But wait, this is where the logic feels like it hits a brick wall for me.
How so?
I really need to push back heavily on this on behalf of every finance professional who has stared at this consolidation working paper. Let's look at the actual economic consequences of what you're saying here.
Okay, let's do it.
Holdco took a painful hit in its standalone profit and loss statement. It recognized a massive loss because, in the real world, the subsidiary is failing and burning cash. That standalone P&L reflected a very grim reality.
Yes, it did.
But now, you are telling me that when we prepare the consolidated books, we are, quote-unquote, eliminating that hit. We are reversing the provision. Doesn't that artificially inflate the group's consolidated profit?
Yeah.
I mean, aren't we just sweeping a massive operational failure under the rug of consolidation adjustments to make the group's bottom line look prettier to shareholders?
You know, your skepticism is entirely justified. I hear this all the time. When you first execute this elimination, it feels deeply wrong.
It feels like fraud.
It feels like a financial magic trick where a real loss is vanished into thin air. And it is incredibly tempting for a management team to want the process to stop right there, with the group profit looking artificially healthy.
Exactly. Look, shareholders, we're doing great.
But standard setters are acutely aware of this loophole. Ind AS is far too robust to let a real economic loss just disappear like that.
So how do they stop it?
To understand why we aren't actually hiding the loss, we have to look methodically at the mechanics of the journal entries, and then crucially look at the massive forensic reality check that the standard immediately triggers right after.
Okay, let's start by demystifying those journal entries first. We need to understand the exact flow of the debits and credits to see where the numbers actually land. So let's tackle the first specific query from the source.
Okay.
When we eliminate this provision, is it a direct credit to retained earnings?
The answer to that is a definitive no.
Okay, why?
The reasoning goes back to the fundamental matching principle of consolidation adjustments. An elimination adjustment at the consolidation level must have its impact routed through the exact same respective line item in which it was originally accounted for in the separate financial statements.
Ah, so you have to trace the breadcrumbs back to the source.
Exactly. You look at what Holdco did in its standalone books during the current year. When Holdco's auditors demanded that provision for the doubtful advance, where did Holdco book the corresponding expense?
Well, they recognized it in the statement of profit and loss for that current reporting period.
Right. Therefore, when we eliminate and reverse that provision during the consolidation process, the adjustment must also flow through the statement of profit and loss. You cannot bypass the P&L and dump it directly into retained earnings.
Right, because retained earnings are generally reserved for prior period errors or retrospective changes in accounting policies. This provision isn't an error. It was a completely valid estimate in the standalone books. We are just adjusting it for the consolidated view in the current year.
Precisely. It is a current year consolidation adjustment of a current year P&L item. So any credit goes to the consolidated P&L, not retained earnings.
Okay, so let's actually walk the listener through the debits and credits of this reversal. We are essentially dismantling the legal architecture that Holdco built.
Yes, let's look at Entry 1, which tackles the elimination of the intergroup provisions. In its standalone books, Holdco created provisions for the impairment of both the investment and the loans. These provisions sit as credit balances on Holdco's ledger, reducing the carrying value of the assets. To eliminate them in the consolidated working paper, we have to do the exact opposite. We debit them.
So the entry is, debit the provision for impairment of investment in subsidiary account, and debit the provision for impairment of loans and advances account. We are debiting those provisions to bring their balances down to absolute zero in the consolidated view.
Right.
And the corresponding credit.
As we just established, the credit goes directly to the consolidated statement of profit or loss.
Okay, let's pause and emphasize the immediate consequence of Entry 1. By crediting the consolidated profit or loss, the profit of the entire group will actually increase to the exact extent of the provision we just reversed.
Yes, it will.
Holdco's standalone profit was heavily dragged down by this bad news. But the moment we prepare the consolidated financials, the profit pops right back up. It creates this temporary, sugar high in the consolidated earnings.
That is exactly what happens. For a brief, fleeting moment in the consolidation process, the group's profit looks significantly better than the parent's standalone profit.
Wow.
But we cannot stop there. We've only eliminated the provision, which is the secondary effect of the loan. We still have to eliminate the actual equity and the underlying loans themselves.
Because if we stop at Entry 1, we still have a phantom loan floating on the consolidated balance sheet.
Right. We've cleared the bad debt provision, but Holdco's X-ray still shows a loan asset, and Subco's X-ray still shows a loan liability. We need to erase the underlying architecture of that debt without unbalancing the whole ledger.
Okay, so let's walk through Entry 2, the consolidation of equity and loans.
For Entry 2, we need to completely wipe out Subco's equity and the intergroup borrowing. Remember, from the single economic entity perspective, Subco's equity doesn't belong to Subco. It belongs to the parent and the outside investors.
Got it.
So, to eliminate it, we debit the equity share capital of Subco account. We also debit the borrowings account, specifically to the extent of the loans given by Holdco, to eliminate the massive liability sitting in Subco's books.
Okay, so we are clearing the board on the liability and equity side. We've debited equity and debited the intergroup borrowings. What are the balancing credits to make this work?
We have 3 credits to balance this entry. First because Subco is not a wholly owned subsidiary. Remember those outside investors we mentioned
All
earlier?
right, the non-controlling interests.
Exactly. We have to
Yeah.
acknowledge their stake. So we credit non-controlling interests. This represents the portion of Subco's equity that Holdco does not own.
Okay, that's one.
Second, we credit loans. This eliminates the gross assets sitting in Holdco's books. And finally, we credit investment. This eliminates the initial investment assets sitting in Holdco's books.
Okay, let me synthesize the result of these two entries. By debiting the provisions and crediting the P&L, and then debiting the liability as an equity and crediting the assets, we have essentially untied the knot that Holdco and Subco created.
Yes.
We've wiped the slate entirely clean of the intergroup loan, the intergroup investment, and every provision made against them. The internal financial plumbing has been completely removed from the consolidated view.
That is a very accurate summary of the mechanical elimination under Ind AS 110.
But this brings me right back to my major pushback.
The friction.
The friction here is immense. We've executed the mechanics perfectly, but we're left with a terrifying reality. We have a failing subsidiary that is burning real cash in the real world, yet our consolidated P&L is suddenly looking rosy because we just credited it with a massive provision reversal. The legal transaction is gone, but the economic failure of the subsidiary's business model remains. If a forensic auditor looks at this, they're going to see a management team that just artificially boosted group profits by hiding behind consolidation rules. How does the Ind AS framework prevent this exact loophole?
And that question bridges us to the reality check, which is the absolute most critical part of this entire deep dive.
Let's hear it.
Reversing the intergroup provision under Ind AS 110 is only step one. It is purely a mechanical requirement to ensure we don't have intergroup balances cluttering the balance sheet. But the accounting framework does not stop there. The standard setters built in a massive failsafe.
A failsafe.
Yes. Step two requires the immediate mandatory application of Ind AS 36.
Oh, in AS 36. The standard for the impairment of assets. This is where the economic reality violently reasserts itself.
Exactly. This is where the auditor stops looking at the journal entries and starts looking at the factory floor. Let's use a specific numerical example inspired by the JAP Advisor source material to make this cascade crystal clear for everyone trying to visualize the impact.
Yes, concrete numbers are essential here. Let's build the scenario.
Okay, let's imagine Holdco made an impairment provision of exactly 100 INR in its standalone books of account for its investments and advances in Subco.
Okay, 100 INR.
Consequently, the profit of Holdco was dragged down, reduced by 100 INR in its separate financial statements. Subco, honoring its legal contract, did nothing in its own individual financial statements. The liability remained intact.
Okay, so the standalone asymmetry is established. Holdco is down 100 INR. Subco is unchanged.
Now, 31st of March arrives. During consolidation, as we just walked through, the Holdco group must mechanically reverse that 100 INR impairment because it relates entirely to an intergroup transaction.
Right. We debit the provision accounts by 100 INR, and we credit the consolidated profit and loss by 100 INR.
Yes. And at this exact fleeting moment, group profit artificially goes up by 100 INR.
There's that magic trick moment again, the sugar high.
But here is the massive caveat, explicitly stated in the source material. However, Holdco Group must test the CGU for the purpose of impairment, considering significant losses.
Okay, let's unpack that acronym immediately. CGU, Cash Generating Unit. We need to define this deeply because this is the pivot point of the entire standard.
A cash-generating unit, under Ind AS 36, is defined as the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or groups of assets.
So it's not a legal entity.
No, you have to stop looking at financial instruments and legal entities and start looking at operational reality. In many cases involving a subsidiary, especially a discrete operational subsidiary, the subsidiary itself or its core manufacturing facility constitutes a CGU.
Okay, so let's say Subco was created specifically to operate a new high-tech manufacturing plant. Holdco gave Subco the loan so Subco could buy the machinery, build the factory walls, and purchase the initial raw materials.
Exactly. When we eliminated the internal loan under Ind AS 110, we only eliminated the piece of paper that said Subco owes Holdco.
Right.
But we did not eliminate the actual physical assets that Subco bought with that money. Subco's machinery, its inventory, its factory building, its receivables from third-party customers, those physical and operational assets all still exist on the consolidated balance sheet. They are the tangible assets comprising the CGU.
Ah, this is the paradigm shift. We stop looking at the financial asset, the internal loan, and we're forced to look at the physical assets, the factory that the loan funded. But why are we suddenly forced to test this factory for impairment?
Because of the concept of impairment indicators, the fact that Subco is incurring significant sustained losses, which is the exact reason Holdco felt compelled to impair the loan in the first place, acts as a blaring smoke alarm.
A smoke alarm.
Yes. It is a massive flashing indicator to the consolidated group and its auditors that the underlying physical assets of Subco might be severely impaired. And AS 36 says you cannot ignore that smoke alarm. You must immediately compare the carrying amount of that CGU against its recoverable amount.
Okay, let's break down that math because this is what the forensic auditor is going to zero in on.
Yeah.
The carrying amount is simply what the factory is currently valued at on the consolidated balance sheet, right? Like the historical cost of the machinery minus accumulated depreciation.
Correct. That is the book value. Now you have to compare that carrying amount to the recoverable amount. The recoverable amount is strictly defined as the higher of two specific metrics. It's fair value less costs to sell, or its value in use.
Okay, let's explore both of those metrics because they represent two very different ways a company can extract value from an asset. Fair value less cost to sell is essentially the market approach, isn't it?
Yes. It asks a pretty brutal question. If we shut this failing factory down today, put a for sale sign on the machinery, and sold it to a third party in an arm's length transaction, what would we get for it after paying the brokers and the dismantling costs?
And for a highly specialized factory that is currently bleeding money, that fair value is often incredibly low. The market doesn't want to buy a failing operation at a premium.
Exactly. So if the fair value is abysmal, management will inevitably pivot to the second metric, value in use.
This is the income approach.
Right. This is where management argues, sure, the market wouldn't pay much for this machinery today, but if we keep operating it, it will eventually generate enough cash to justify its book value.
Oh, and this is exactly where the friction between management and the auditor reaches its absolute peak.
Oh, you know it.
Because value in use is the present value of the future cash flows expected to be derived from the CGU. To calculate this, management has to build a complex discounted cash flow model. They have to project Subco's revenues, expenses, and capital expenditures for the next 5 years, calculate a terminal value, and discount it all back to today's value using an appropriate discount rate, typically the weighted average cost of capital, or WACC.
And this is where the behavioral aspect of finance comes into play. Management, fresh off the sugar high of reversing that 100 INR loan provision under Ind AS 110, is highly incentivized to make those value and use projections look incredibly optimistic.
Naturally, they want the recoverable amount to be higher than the carrying amount so they don't have to recognize an impairment on the factory.
Exactly. They might project aggressive revenue growth, sudden cost efficiencies, or use a lower discount rate to inflate the present value. But the auditor, guided by Ind AS 36, has to rigorously challenge those assumptions.
Right. The auditor will look at Subco's historical failure to meet budgets and demand to know why the next 5 years will magically be different. They will stress test the discount rate. They will look for optimism bias.
Because the standard forces a collision with reality. If the auditor strips away the optimistic fluff, and the mathematical reality shows that the value in use is also abysmal, meaning the factory is never going to generate enough cash to justify its carrying amount, what happens?
If the higher of the fair value and the value in use is still lower than the carrying amount of the CGU on the balance sheet, then an impairment loss must be recognized immediately in the consolidated financial statements.
Yes. The group must write down the value of the actual factory machinery, the building, the goodwill associated with Subco, right there in the consolidated P&L.
So what does this entire cascading process actually achieve? I see the architecture now. We aren't hiding the loss at all. Not at all. We are entirely reclassifying it. We are shifting it from a paper loss on an internal financial loan in the parent standalone books to a real-world operational loss on actual physical business assets in the consolidated books.
That's it.
It shifts the entire focus from the legal paperwork drawn up between the parent and subsidiary to the actual economic health and viability of the business unit that is facing the outside world.
That is the perfect synthesis. The genius of the standard is that it translates a financial loss on a financial instrument, the internal advance, into an operational loss on tangible or intangible assets. It ensures that the consolidated balance sheet accurately reflects the diminished economic utility of the group's real-world resources, rather than just reflecting internal contractual disputes.
I love that.
Yeah.
Now, I want to ask a very specific follow-up question based on the original query, just to make sure we leave no stone unturned here.
Sure.
The user on the JAP Advisor site specifically asked, what would be the treatment for advances provided during the year? We've been framing this around historical loans that have gone bad over time. Does the accounting treatment change at all if Holdco gave Subco a new loan during this current financial year, realized within months that Subco was going to burn it, and then immediately provided for it before year-end?
That is an excellent nuance to pull out. The short answer is no, it doesn't change the underlying mechanics of consolidation whatsoever.
It doesn't.
No. Whether the advance was given 5 years ago, 5 months ago, or 5 days before the balance sheet date, if it is an outstanding advance between the parent and the subsidiary at the reporting date, March 31st, it is definitively an intergroup balance.
Right.
Therefore, under the strict mandate of Ind AS 110, paragraph B86C, that advance and any provision made against it must be eliminated in full during consolidation. The timing or the vintage of the advance does not grant it an exemption from the fundamental principle of elimination.
Okay, so the consolidation MRI doesn't care when you move the money from your left pocket to your right pocket. It only cares that the money is still sitting within the same pair of pants when the snapshot is taken at year-end. If it's internal, it gets eliminated.
Exactly. Another great analogy, the temporal aspect of the loan creation is completely irrelevant to the consolidated balance sheet presentation.
Let's zoom out from the specific entries and look at the broader implications. Why does this deeply technical, multi-layered process matter so much to the chief financial officers, the audit partners, and especially the CA students who are listening to us right now?
Well, because on the surface, to a layperson, it seems like a tremendous amount of journal entry gymnastics, right? Eliminating a provision here, testing a CGU there, just to end up recognizing a loss anyway.
Yeah, exactly. Why not just let the original loan provision stand in the consolidated books?
It matters profoundly because of the structural discipline it enforces across corporate reporting. It prevents companies from manipulating their consolidated results through arbitrary intergroup pricing, artificial loans, or selective provisioning.
That makes sense.
But perhaps more importantly, the framework acts as an unavoidable systemic early warning system. Let's revisit a specific sentence buried within Ind AS 110, paragraph B86C. It is incredibly profound if you understand its implications.
Lay it on me.
The standard states, intergroup losses may indicate an impairment that requires recognition in the consolidated financial statements.
Wow. Intragroup losses may indicate an impairment. It's written right into the DNA of the consolidation standard itself. It's not just a suggestion. It's a structural tripwire.
Exactly. While the standard demands that you surgically eliminate the intragroup loss, whether that is a loss on a loan provision or a parent company selling inventory to a subsidiary at a massive loss just to clear out old stock from the parent's books, the standard simultaneously points a giant neon finger at that exact transaction.
And it says to the auditor, look right here.
Yes. The intragroup loss is a massive red flag indicating that an impairment of the underlying physical asset might be required in the CFS.
It is forcing the auditor and the management team into a really uncomfortable conversation.
Very uncomfortable.
The auditor asks the hard question. Why did Holdco management feel the absolute need to impair this internal loan in their standalone books? Management has to answer. Because Subco's underlying business is failing.
Right.
And the auditor replies, therefore, we must now assess if the actual assets of that failing business need to be written down. You can eliminate the mechanical journal entry, but you cannot eliminate the grim economic reality that necessitated the journal entry in the first place.
Precisely. You cannot use consolidation as a shield to hide operational failure. And, this brings us to another massive layer of complexity that finance teams must meticulously document, which is also explicitly mentioned in that same paragraph of the standard.
Oh, I know where you're going. Tax implications.
Yes, taxes. The standard clearly states that Ind AS 12, which governs the accounting for income taxes, applies directly to the temporary differences that arise from the elimination of profits and losses resulting from these intragroup transactions.
Oh man, this is where the cascading effect gets truly complex. Let's unpack the tax angle.
It's a headache, but it's crucial.
In its standalone books, Holdco recognized a massive expense when it provided for the loan. Depending on the specific local tax laws and tax jurisdiction, Holdco might have actually claimed a tax deduction for that provision in its standalone corporate tax return reducing its current tax liability.
Yes. Or, if the deduction isn't immediately allowed, Holdco recognized a deferred tax asset, anticipating a future tax benefit when the loan is officially written off.
Right. Holdco's standalone tax position has been fundamentally altered by the recognition of that provision. But remember what we just did in the consolidation working paper.
We completely reversed that provision.
Exactly. We eliminated the expense.
Yeah.
So we have a massive discrepancy. In the consolidated accounts, the accounting profit has jumped back up because of the reversal. But the reality reported to the tax authorities based on the standalone legal entities has not changed.
Exactly. When you reverse that provision in the consolidated P&L, you are instantly creating a difference between the carrying amount of the asset in the consolidated balance sheet and its tax base. This creates a temporary difference.
And under Ind AS 12, whenever you have a temporary difference, you are required to account for it by recognizing either a deferred tax asset or a deferred tax liability in the consolidated financial statements.
Yes. So the finance team isn't just dealing with the headache of adjusting the impairment figures and running discounted cash flow models for the factory.
No, they are also forced to recalculate and adjust the deferred tax figures in the consolidated statements to reflect the reality that the group's accounting profit and taxable profit are temporarily wildly out of sync. It creates a cascading avalanche of mandatory adjustments.
And this cascading complexity is exactly why having access to a resource like the DAP Advisor's issue repository is an absolute necessity, not just a luxury.
I completely agree.
If you are an audit junior or even a manager, you cannot simply document in your file. We reverse the Intergroup provision as per Ind AS 110 and just call it a day. That is an incomplete audit.
That absolutely.
You have to meticulously document the reversal under Ind AS 110. You then have to document the subsequent impairment testing of the CGU under Ind AS 36, including how you challenge management's cash flow assumptions.
Right.
You then have to document any resulting write-downs of specific physical assets. And finally, you have to document the deferred tax implications and temporary differences under Ind AS 12. Having all of those interconnected steps laid out in a structured, expert response from the repository is a total lifesaver. It provides the exact roadmap for a fully compliant audit file.
It truly illuminates the interconnectivity of the Ind AS framework. You can rarely look at one standard in isolation. They are designed to talk to each other, to trigger each other, to prevent any gaps where economic reality might slip through the cracks.
They really are.
Let's do a comprehensive recap to synthesize everything we have covered today, because we have gone incredibly deep into the forensic mechanics of accounting theory.
Let's do it.
The core puzzle we started with. Holdco writes off a massive loan to its struggling subsidiary, Subco, taking a huge hit. Subco, bound by legal contract, does not mirror that write-off. We are left with an asymmetrical ledger. What happens at the moment of consolidation? The elegant logic of the standards gives us a very clear, albeit complex path. Standalone books reflect the legal reality. In that legal reality, Holdco lent money. The borrower is failing, so Holdco recognizes an expected credit loss.
Correct. The standalone books serve their purpose of reflecting the legal rights and obligations of the individual entity.
But the consolidated books are forced to reflect the broader economic reality. In the economic reality, the unified group cannot lend money to itself. So the internal loan, the internal investment, and every provision attached to them are entirely eliminated under Ind AS 110.
Yes.
The debit goes to the provision accounts to wipe them out, and the credit goes directly to the consolidated statement of profit or loss, matching the original entry. There is absolutely no direct credit to retained earnings.
Right. The slate is wiped entirely clean of the internal financial transaction. The legal fiction is dismantled.
However, and this is the massive critical however that auditors must look for, that reversal is merely step one. The very fact that the parent was forced to impair the loan is a blaring smoke alarm, indicating that the subsidiary's operations are in deep trouble.
The smoke alarm.
Exactly. So step two immediately triggers in AS 36. The group must pivot and test the actual physical cash-generating unit, the subsidiary's real-world factory, machinery, and inventory for impairment. If the carrying amount of those physical assets is higher than what the group can realistically recover through sale or use, those actual assets take the hit in the consolidated books.
You have captured the exact progression and the spirit of the standards perfectly.
Thank you.
The loss does not disappear into the ether. It transforms. It mutates from a financial impairment of an internal paper receivable into a tangible impairment of a real-world operational asset. This mechanism ensures that the consolidated balance sheet accurately and transparently reflects the diminished value of the group's actual economic resources.
It is genuinely a beautiful, logical system once you see how all the gears interlock. It prevents the double counting of assets, it aggressively prevents the hiding of operational losses through consolidation loopholes, and it forces a true, harsh valuation of the group's underlying assets.
It is a masterclass in standard setting, honestly. And as we wrap up this incredibly detailed deep dive, I want to leave the listener with a final provocative thought to mull over. A question to ask yourself as you head back to your spreadsheets, your audit files, or your textbooks.
Oh, I like this. What's the thought?
We have seen today how a parent's provision on an internal loan acts as a brilliant smoke alarm, forcing a rigorous forensic impairment test on the subsidiary's physical assets. So, as you look at your own corporate group structures or the complex structures of the clients you are currently auditing, what other internal transactions are currently sitting quietly in your standalone books that are secretly waving a massive red flag about the actual consolidated economic health of the business?
Oh, that's a good one.
Are there intragroup inventory transfers happening at a massive loss just to shift margins? Are there highly subsidized internal service fees or royalty payments that don't reflect arm's-length market reality? What other smoke alarms are ringing softly in the standalone ledgers that require your immediate forensic attention at the consolidated level before the financial statements are signed off?
That is a fantastic, slightly terrifying question to ponder. It fundamentally changes how you look at those mundane intercompany reconciliation spreadsheets. It is no longer just a mechanical exercise of matching debits and credits. It is about actively listening to what the friction between those numbers is trying to tell you about the operational health of the business.
Exactly.
Well, that brings us to the end of our journey today. We sincerely want to thank you, our audience, for your time spent listening to this deep dive. We know how incredibly busy your schedules are, and we deeply appreciate you choosing to spend this time learning, exploring, and unraveling the intricate complexities of Ind AS with us.
We really do.
If you found value in today's intense discussion, we have a small favor to ask. Please take a moment right now to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. We are available on Spotify, on Amazon Music, and on YouTube. So whichever platform you prefer to listen to the Gap Advisors Ind AS Clinic podcasts on, just hit that subscribe button so you never miss a deep dive.
And beyond simply subscribing, we have a much stronger request. The core mission of this platform is to elevate the understanding, the critical thinking, and the correct application of Indian accounting standards across the entire finance profession. You can actively help us achieve that mission.
Yes, please do.
Please share this deep dive among your professional contacts. Send it to your colleagues, share it in your firm's group chats, forward it to your audit teams, and send it to your corporate finance departments.
And especially, please share this with any students you know who are currently pursuing their CA, their Chartered Accountant course. The concepts we dissected today, the intricate cascading interplay between Ind AS 110, Ind AS 36, and Ind AS 12 bill order, are exactly the kinds of practical, highly complex scenarios that appear in final exams and in the brutal real world of audit articleship.
Definitely.
Helping them understand the why and the how behind the journal entries rather than just memorizing the what is the absolute best way to support their educational journey.
Absolutely. The more we spread this critical forensic knowledge, the stronger and more transparent the entire financial reporting ecosystem becomes. And please don't forget to check out GarrettAdvisors.com and register for free to access those 4,500 plus expert issues. It is a tool you want in your arsenal.
Thank you all once again for tuning in. Keep questioning the numbers, keep looking for the smoke alarms, keep learning, and we will catch you on the next deep dive.